After studying this module, you shall be able to know the various sources of finance, identify the need for financial assistance, analyze the impact of using various sources of finance, and evaluate the effect of covenants in the agreement with financial institutions. Every project involves a lot of capital investment, and therefore it must be determined what should be the total amount of capital required for taking up the project and what are the various sources which should be used for arranging this capital. Further, the capital is required for investment purposes as well as for working capital. It must be determined in advance the amount of working capital that will be required in the project. An existing firm will require this for growth and expansion, and a new firm will require it for setting up the project initially. Source of finance. Once the project costs are estimated, the next step is to find the means of financing it. There are majorly two types of financing pattern: ownership and debt. In a special case, even the portion of capital is also financed by financial institution called as seed capital. These various sources are not considered in isolation. Rather, a mix of these may be decided. The sources of financing and the finance mix should be chosen very carefully, as they have immense impact on the profitability and the riskiness of the project. All the available options should be carefully analyzed and their costs should be calculated, and thereafter the right mix should be decided. The various sources of finance are as follows. 1. Equity share capital. Equity share capital is the capital contributed by the owners of the firm. A part of equity is held by the promoters and the rest is issued to the public. The equity is a less risky source of financing the capital, as there is no obligation to repay the capital back to the owner until there is liquidation of the company. The dividends are also paid when there are profits. The company is under no obligation to distribute dividends if there are no profits. However, there is one risk that the ownership gets diluted. Another disadvantage is that dividends do not qualify as an expense for tax purposes. Rather, corporate dividend tax or dividend distribution tax is levied on the companies under Section 1150 of the Income Tax Act of 1961. The second is preference share capital. There is another form of ownership capital and is known as preference share capital. These shareholders have preference when payment of dividend is made to the shareholders. They are paid dividends before making any payment of dividends to the equity, and in the same manner. They are repaid capital before making any payment to the equity at the time of liquidation. However, preference shares get dividend only at fixed rate or percentage on the face value of the shares. Preference dividends are not a tax deductible expense, and corporate dividend tax is to be paid on these dividends. Thus, we can say that preference shares are a hybrid of debt and equity capital. As per Section 55 of the Companies Act 2013, the maximum redemption period is 20 years. It is 30 years for an infrastructure company. It means only redeemable preference shares can be issued. Just like debt, they are also redeemable. Debentures. Debenture is a debt which is raised through the issue of debentures or bonds by the company. The main features of debentures are as follows. 1, they can be convertible or non-convertible. If they are convertible, they can opt for shares at the time of redemption. In fact, they can be partly convertible or fully convertible. They are registered in the name of the debenture holders and are generally secured by a charge on the assets of the company. They may, however, be unsecured as well. Debentures or bonds do not have a fixed period of maturity, but generally they have a life of 5 to 10 years within which they are redeemed. They are paid interest at a fixed rate, and this debenture interest qualifies as an expense for tax purposes. The amount that has to be raised through debt capital is to be carefully determined depending upon the total capital requirements of the company as well as the capital mix. Debentures can also be issued in the foreign markets to raise capital through foreign investors in the foreign currency. They could be convertible in nature and termed as euro convertible bonds. We next come to term loans. Loans may also be taken from financial institutions and commercial banks rather than issuing debentures to the public. These loans are extended by the financial institutions or commercial banks for setting up a new project, or if the existing unit is undertaking any expansion program or diversifying. These loans are again available for a period from 5 to 15 years. These loans can be extended in foreign currency if the firm needs to import machinery from a foreign country. These loans are always secured against a charge on the assets of the firm. If the assets are acquired from the amount of loan, the banks have a first charge on those assets and also a second charge on all other assets of the firm. Loans can also be taken from NBFCs or non-bank financial corporations, and it may also be taken from venture capitalists. There can also be syndication of loan in which there is a tie-up between various financial institutions for providing finance together. This could be arranged by merchant bankers. The merchant bankers may also secure credit rating from an agency for the firm. A lot of formalities are required to be followed before a syndicate loan is availed. Venture capital. Again, venture capital is related with funding of new risky projects. Venture capital funding has gained tremendous momentum in the past few years. The concept came into picture in 86-87. The first venture capital funding was provided by IDBI. The main reason for this venture capital fund was to provide finance to even those areas which are not proven, which can use new technology to manufacture new product, and at times this can be risky. The traditional financing by commercial banks and financial institution is always in areas where there is safe technology. If this pattern continues, there cannot be any development in new areas and innovations would not be encouraged. So if investments are required to be made in risky project ventures, venture capital is a good means of financing the project. Innovations in technologies needed innovative financing, ergo venture capital, which means high risk, high return. In November 1998, the government issued a set of guidelines to promote venture capital investment in new companies. Venture capitalists provide finance in the form of either debt or equity. They also monitor how the investments are doing and after some time take an exit route. Seed capitals. Sometimes medium-sized projects are being set up by the promoters and they're able to arrange loans and financial assistance from financial institutions. But the promoters fall short of their contribution and they are unable to start the venture. They are provided seed capital in such circumstances by financial institution. Thus, seed capital is a form of finance provided by the financial institution to start up those businesses that they are not able to start because the promoters do not have enough finance and they need that extra money. Bridge finance. The projects are financed through loans taken from financial institutions. However, sometimes it might take some time after the sanctioning of the loan and before the disbursement, and the project may be unnecessarily delayed due to these formalities. To avoid this, bridge finance may be taken from commercial banks to bridge this gap. When the financial institution will disperse the loans, the commercial banks will be repaid. The commercial banks generally charge higher rate of interest for this bridge finance, and it is also secured by mortgaged against immovable property and hypothecation against movable property. Pledge and hypothecation. Pledge is a bailment of goods for the purpose of providing security for payment of debt or loan or the performance of a promise. The assets pledged may be goods or some other valuable documents or securities. The person who deposits his assets with another is the pawner or the pledger, and the person to whom the goods are deposited is known as the pawnee or the pledgee. It is one of the good means of finance for the lender, as his money is safe and he has a lien on the assets pledged. Similarly, the borrower also finds easy to secure finance through this means. Hypothecation is a charge against property for an amount of debt when neither the ownership nor the possession is passed on to the creditor. The assets are only available as a security for a debt without passing on the delivery. It is good for the borrower in the sense that he can continue using the assets. Besides, it becomes additional means of financing through those assets which cannot be pledged. Obviously, a manufacturer has a lot of capital blocked in stocks of raw material and finished goods which cannot be pledged. So if a loan is to be raised and these assets are offered as security for the repayment without pledging, a charge can be created against these assets. Financial institutions. Now, financial institutions are formed primarily for the purpose of fulfilling financial needs. As per Companies Act 2013, a financial institution includes a scheduled bank and any other financial institution defined or notified under the Reserve Bank of India Act of 1934. The financial institutions can be classified into two broad categories. One is the national level financial institution and the second category is state level financial institutions. Now, if you're looking at the all India level financial institutions, the purpose of all India level financial institutions is to provide finance to large and medium enterprises. Its finance to the small scale sector is negligible. The major all India level financial institutions are as follows. The first and foremost being the Industrial Finance Corporation of India, or the IFCI. This institution was established in India in the year 1948 and it was the first financial institution. The objective of this institute is to provide long and medium finance to the industries. Second is the IDBI, or the Industrial Development Bank of India. This was established in 1964 as a subsidiary of the RBI, but in the year 1975 it became a wholly owned Government of India undertaking. Its main objective was to serve as an apex financial institution in order to coordinate the functioning of all other financial institutions. Third, we have the Life Insurance Corporation of India, or LIC. This was established in 1956 by amalgamation and nationalization of 245 private insurance companies by the enactment of the Parliament. The main business of LIC is to provide life insurance and almost had a monopoly in it, but it could also invest 10% of its fund in private finance, which it provides as a consortium, and it does not therefore undertake appraisal of projects. We have the General Insurance Corporation of India. This was established in 1974 by nationalization of general insurance business in India. Just like the LIC, it can finance but only up to 30%. Fifth, we have the Unit Trust of India, which was founded in the year 64 under the Unit Trust of India Act of 1963. The primary objective of the UTI was to mobilize the savings of households and to channelize them to those who require them. The sixth one is the Export-Import Bank of India, or the Exim Bank. This was established in the year 1982, primarily to provide finance to exporters and importers. Seventh, we have the ICICI, which is the Industrial Credit and Investment Corporation of India. This was established in 1955 and provides a consortium of services. Eighth, we have Small Industry Development Bank of India, set up in 1990 under the Act of Parliament as a wholly owned subsidiary of IDBI to provide finance for small-scale industries. We then come to state level financial institutions. State Financial Corporations, or the SFC Act, was passed by the government in 1951 when it felt the need to develop state level institutions to provide finance for small and medium enterprises. State Industrial Development Corporation, or SIDC. These were also provided by the government for rapid industrialization and provide finance for some projects in the state. They even identify the industries which need to be developed in the state. What is the procedure now for sanctioning a term loan? Any concern that needs assistance from the institution has to submit an application in a prescribed format to any of the institutions. The application should be complete in all respects, should carry with it the copies of the approvals required to be obtained from the government agencies, agreement for foreign technical collaborations, etc. As the institution, they do not process incomplete applications. The following steps are followed by the financial institutions after the application has been submitted. The first step is preliminary scrutiny. The officer of the institution checks the application for its completeness. It then prepares a flash report, which is a summarized extract of the whole application, and is then presented to the senior executive for approval. The senior officer may grant in principle approval for the project, and then it could submit it to a lead institution for a detailed appraisal. The next step is appraisal of the project. The institution may ask for further information within a period of 15 days. If the institution decides to finance the entire project on its own, it may do so after looking at a detailed appraisal of the project. And if it wants it to be financed through a consortium of all or a number of institutions, then they need to hold a final meeting. Step 3 is sanctioning of finance. As soon as the meeting gives its recommendations to sanction the loan, the board of directors will give the final approval to give financial assistance. The information of sanction of the loan, together with the terms and conditions of the loan, is given to the borrower through a letter. If the loan is sanctioned by the consortium, the other lending institutions also approve their respective share of the loan at their board meeting and send a copy of the resolution to the main lead institution together with a copy to the borrower. The fourth step is the disbursement of loan. The sanction of the loan is granted subject to the fulfillment of certain conditions, and may be a nominee director is also to be appointed on the board of directors of the borrower. If the borrower agrees and conveys his acceptance, the formalities are completed and the loan is disbursed. The loan agreement is first signed by the borrower and then by the officials of the lead institutions. We then have what is known as a detailed project report, or the DPR. The detailed project report is the most important document submitted by the borrower to the lead financial institution. It is a culmination of all the analysis. All the analysis, that is the market analysis, the technical analysis, the financial analysis, is presented in a very systematic format in the detailed project report. Some financial institutions insist on the formats they have released and consider the DPR only in that format. The contents of the DPR are as follows. First, general information, which includes the name, the sector, the location, the nature of the industry, etc. Secondly, the details of the promoter, the contribution of the promoters. Third, other means of financing the project. Fourth, marketing and selling details. Fifth, details about the project, the capacity of the plant, the location, the plant size, the kind of raw material that is going to be used in the project, the utilities required and their availability. 6, the various environmental aspects regarding the project. 7, the project income statement and the profitability of the project. 8, the project balance sheet as well as the projected cash flow statement. 9th, the production process. 10th, the schedule for implementation of the project. 11th, profitability analysis. Then we have the economic considerations, and then we have the appendices required to be attached with the DPR, which are 1. Estimates of costs of production. 2. Calculation of various relevant ratios. 3. Calculation showing depreciation. 4. Calculation showing tax implications. 5. The outcome of various financial appraisal techniques. 6. The findings of NPV and IRR, etc. 7. The sensitivity analysis report if done. And 8. The scenario analysis if done, etc. Thus, now we will come to the summarizing what we have just done. One is that the various sources of finance are equity share capital, preference share capital, debt, venture capital, etc. Second, equity and preference share capital contributed by the owners of the firm. Third, preference share capital means the shareholders have preference when payment of dividend is made to the shareholders, as well as when repayment is done at the time of liquidation. Fourth, debenture is debt which is raised through the issue of debentures or bonds by the company. Fifth, term loans may also be taken from financial institutions and commercial banks rather than issuing debentures to the public. Sixth, venture capital funding has gained tremendous momentum over the past few years. The concept came into the picture in the year 1986 and 87. 7. Seed capital. Sometimes medium-sized projects are being set up by promoters and they are able to arrange loans and financial assistance from financial institutions also. 8. Bridge finance may be taken from commercial banks to bridge the gap between the sanction and the disbursement of loan and its requirement. 9. Pledge is a bailment of goods for the purpose of providing security for payment of debt or loans or the performance of a promise. 10th, hypothecation is a charge against property for an amount of debt where neither the ownership nor the possession is passed on to the creditor. 11, the financial institutions can be classified into two broad categories. One is national level financial institution and the second is the state level. 12, the detailed project report is the most important document submitted by the borrower to the lead financial institution. It is the culmination of all analysis. It must contain all the essentials. Some financial institutions have even released the formats in the form that they want it done.